why wouldn't you treat yourself the same way that a hedge fund treats their investors' money? Welcome back, ladies and gentlemen. Today we're going to talk about two topics that I have found over the years that newer investors tend to make mistakes on, okay? And I've made this mistake myself. It's just something that we do as new investors. Let me paint you a picture. You have the perfect stock in mind, something that you are emotionally attached to, you think that it's fair value, and you have money to buy this stock with, right? And you probably have a decent amount of money. Maybe you saved up all year, $15,000, $20,000, okay? When people are emotionally attached to a stock or just an item in general, whether that be even just a car or a house or just some sort of materialistic item, we have a tendency to overpay and not really think about what we should be paying for it, okay? So same goes for stocks, guys. When a stock's going up and down and it has a couple of down days and you're new to investing and you want to buy this stock and you have done your research and this is the one that you want to put money into, first mistake that people make is not trying to figure out a valuation of a stock, okay? And beyond just what you think the stock is worth, like really dig into the numbers, figure out what the market cap is. What kind of multiple does that sector demand? So if you're in technology, and it's a growth it's in the growth side of technology, does it demand a 40, 50x multiple? So you have to understand what sector it's in. One of the biggest mistakes I've come across, especially on YouTube and some of these newer investors that are coming out, is that they tend to dump their money in at they dump a large sum of money in at one time, okay? And that's a huge mistake that a lot of people make. Even when I worked in financial services, that was a big mistake. People wanted to hurry up and get to the market. The bottom line is, guys, that stock and the market's going to be there for years and years and years. Well, you hope so, right? If you pick a good one, it should be there forever. What people don't take into consideration is that there are cycles that go on in the market. We have downturns. People miss earnings. Management gets fired. Companies inside sell and inside buy. All these types of things are going to drive a price in either or direction. And it's an exciting name. Everybody's rushing to get to it. First, what do you think is going to happen? Supply and demand is going to shrink because a lot of people are rushing to this stock. It's the new hot thing that's out there, right? So that's going to drive the stock price high by nature. Now, all of a sudden, your valuation from where you think the stock price is versus where it is now, question one is, are you starting to overpay now, right? Question two is, did you do your due diligence and figure out what true valuation should be and what kind of price point you should be buying in this stock, right? So these are questions that you need to figure out as an investor. And these are some of the questions that every time I take a look at a stock, I have to take a step back because I do get emotional when I start figuring out the business model. Wow, like the total addressable market on this company could be massive. And you start building it up in your mind, right? And what you have to do is really take a step back and say, what is this stock worth today? What do I think it's going to be worth in 5 or 6 years? And what price point am I willing to pay for this stock today and over the next couple years? So I'm going to use a couple examples, guys. I'm going to use Tattooed Chef. I'm going to use Palantir. I'm going to use Robinhood's another great one. So let's use Robinhood, guys, right? A lot of people are on Robinhood's platform, and they're going to compare Robinhood to other banks that have been around for hundreds of years. Now, first, is that appropriate to do that? Probably not, right? Robinhood's been around for a shorter period of time. They don't have the resources to make income like a JP Morgan makes, right? Off of credit cards, home loans, car loans. So you really have to wonder, like, what kind of market cap should you be putting on a company like Robinhood, where really the bread and butter of their business model is basically done on transactions, right? And the average person that holds an account with Robinhood, I believe the average investor that's on Robinhood's platform is under $10,000. So not only is their business model based on transactions, but it's also not large transactions, right? These are very small to medium-sized transactions for the most part. You're not moving $200,000 to $300,000 per transaction, right? So when we look at that business model, we have to say, hold on a second here, $39, okay? You bought Robinhood for $39. You were down over 65%, guys. I want you to understand that. So you're down 65%, which means you basically need to be up 170% to get your money back. So when a stock goes down, guys, when a stock goes down 50%, you realize in order to regain those losses, the stock has to go up 100% from where it's currently sitting. This is why it's so important not to dump all your money in at one time when you have a stock in mind and when you're starting to invest. So the strategy I take, guys, or the strategy I always recommend is, first and foremost, what are you willing to pay for the stock? Don't look at the daily price of the stock, okay? I take the stock price off your mind, right? Erase it off your mind. What you need to do is dig into the numbers of the company, right? So dig into those numbers. What's their revenue? What's the cost of revenue? What sector are they in? How fast are they growing revenue? When are they projected to be profitable if they're not profitable? How much cash do they have on the balance sheet? Minus the assets and liabilities. And I've seen so many people rush to this market that we've been in because over the last 20 something months, it has done nothing but go in a straight line, guys, right? And so people have gotten lazy in their thought processes and have become extremely comfortable and reliant that if they just dump $20,000 in any stock right now, that it's gonna go up. And that's just not the case. So I wanna use Robinhood as an example, right? If I was starting to build a position in a stock, and let's just use $20,000, and personally, guys, I put a price target well below $20 on Robinhood when it IPO'd. If anybody that's followed me on this channel, I've said anything under, I said Tattooed Chef is about a $14 stock. I said Robinhood is well under a $20 stock. I thought Palantir was extremely expensive at $25 and giving it this massive market cap. So, and this is just my personal opinion, guys. Doesn't mean I'm right or wrong. Okay, I want you to understand that because I got ripped and ridiculed for trying to help you guys with valuations. Okay, people would leave mean comments saying that I don't know what I'm talking about, that Robinhood will never get below $20, that Palantir will never get below 15, and that Tattooed Chef would never get below $16. I was called an idiot and stupid for that, okay? And where are we today? Every single one of those prices are below where I was willing to pay for them, okay? All those prices are now below where I thought they were gonna be. So even I overestimated what I thought a lot of these companies were worth, and I'm a cheapskate when it comes to valuations. But I know what I was willing to pay for it, and that's the important thing. If I'm gonna buy a company over the next 1 or 2 years, then I need to know what the 5 or 10 year outcome for that company is going to be, because if it starts underperforming and things start going sideways, I need to know that I have a stop loss and an exit strategy to get out of this position. If management doesn't execute right, we have to think about these things. What if they start dumping a lot of shares on the market? What if they lose a big contract and they're not profitable anymore? So there's things that are gonna come, and prices are always gonna present themselves. So you never need to rush into anything. I feel like a lot of people get the FOMO action, right? They feel like they're gonna miss everything. That's just not the case, guys. You can go back in history and look at companies like Facebook that IPO'd. You had a full year to buy Facebook, and it came out, exploded up, and then came back down, right? Just like every time something IPOs, you get this massive explosion, and then it comes back down drastically. And that's when I would recommend starting to build a position, right? I wouldn't jump in at the initial reaction. Let it die out after 4 or 5 days, maybe even a week or two, okay? And at that point, you'll start seeing insiders selling their positions because they took on 100% equity, so they have to start selling their positions in order to make money, right? So insiders are going to start selling. That's going to cause bad news by nature. That's going to cause retail to start selling. That's going to cause more and more selling pressure. It's going to cause people to short. And then all of a sudden, you get this massive sell or massive drawdown on an overreaction from the initial public offering, right? So you get this massive drawdown. During that massive drawdown is a great time to start building a position. Now, if it's hitting 52-week low after 52-week low, don't try to catch a falling knife. So you buy very, very small positions. An example would that be, once again, using $20,000. If I had $20,000, maybe I would be buying every week, I'd be buying $500 worth of that stock. just slowly. As we waited for it to come down, it's starting to hit that price point that I've talked about, that I feel comfortable of the valuation of the company, and I start adding $500 a week, $500 a week. Then it misses earnings. All of a sudden, the stock's down 20%. Great. I'm sitting on plenty of cash on my $20,000. I'm gonna buy $5,000-$6,000 worth. Boom. So you dollar cost average into these positions, and it's going to be different for everybody. So maybe that $20,000, I took a whole year to build my position in the stock. I didn't just dump it in all at once. And I think that's a big mistake a lot of new investors make, is they're so excited to get investing, and they feel like they're going to miss the big run up, and they dump a large sum of good money into a stock that might be overvalued, or people that have been buying that it's definitely overheated or overvalued at this point. So you see that a lot with new investors, and that's just not a smart way to do it, right? What you do is just slowly average into a position once it starts hitting a price point that you like. And then if you're that convicted on that price, if you're that convicted on that stock, you just keep averaging in on the dips, keep averaging in on the dips. The opportunities are going to present themselves. You're never going to miss out on it. The second mistake we all make, guys, is we put too much conviction into one stock, right? We put too much confidence, too much conviction in one stock. I can't tell you how many companies that I've looked at in the past that I thought were great buys, that had great business models, that had great management in place, they were profitable, and something happens outside the realm and they flop, and the stock will never recover the way you thought it was going to recover. I think we look back and you look at a company like Intel, and I think when Intel initially IPO'd, it was a $70 stock, guys, and it's trading at $40 in the mid to high 40s nowadays. So just because you get these massive spikes doesn't necessarily mean that you need to chase that, right? You should have a plan. What is the valuation of the company? What are you putting a price tag on this stock for? That way there, if you're buying it at a deal, and when it gets cheap, are you buying it at a real big discount? And you'll feel more comfortable taking on smaller and smaller pieces, because you didn't just YOLO all your money into one stock and try to time the market, because that's essentially what you're doing. If you're dumping a large sum of money into the market on one stock, you're trying to time the market, guys. And we know how that goes, right? That's when you become super emotional and you don't make rational decisions, right? So I want to talk about the psychology of this, because it's just really overlooked, okay? You don't need to dump large sums of money. Even hedge funds, guys, you see it all the time. They'll take on a position, they'll sell out of some other positions that are up, buy some later, they'll build up cash, they'll buy some more later, and it's usually 4 or 5 purchases throughout a 12-month period on a position that they're trying to build in, right? So they don't just YOLO, if they got $1 billion under management, they're not just going to take that billion and buy it all at one time in one stock. That's just not how that works, right? Because that is huge risk. They're essentially lots of risk, because what if that industry goes under? Then they just lost all their investors' money, right? They're going to be getting sued left and right. Treat your money the same way as the hedge funds treat their investors' money, guys. I do this so you guys are not in that situation, because I've been there, guys. I've been there where I've YOLO'd my position. I've been YOLO'd into positions and it just didn't work out for me. Just something to think about, guys. As always, I appreciate your time. Thank you so much for spending it with me, and we will see you next time, investors. Peace.